that doesn't happen anymore.
Apart from Reliance, of course, in the oil and gas space, Prabhat, would you prefer any of the other stocks, and do you think they have the steam to take the market forth from here?
So we are still very concerned about the policy on oil and gas sector, and also remember that we have a very bullish view on oil going forward. So we actually downgraded ONGC some time back based on a global view of oil. We believe that oil prices will rise further, even though they have fallen in this crisis. But we believe that going forward there will be an upward push, and that essentially means that the subsidy issue will probably remain unresolved to a large extent. To that extent, given the policy, that policy is not clear, and there have been a number of committees which have given the recommendations and nothing has come through, we essentially continue to remain largely negative on the OMCs, and we have downgraded ONGC to neutral. We do like GAIL, but we also believe that in the short term, it also faces the same headwinds of subsidy. But we like this pipeline business, which is growing very strongly. So from that perspective, we do like GAIL. But NGC, which is the largest stock, we have actually downgraded last week.
We're still getting to the end of it, Prabhat, because this is an extended earnings season. But what have your takeaways been so far? I mean, from what you're seeing right now, is there reason to upgrade the market or upgrade earnings on specific stocks, or has it been quite flat by way of a performance?
So in terms of the way earnings have come through, this has not been a surprise quarter. So it has not been a quarter where you have seen massive surprises that you saw in the March quarter and June quarter and September quarter. This has been I would say, an inline quarter. There have been stocks which have surprised positively. There have been stocks which have surprised on the negative side. And on an overall basis, I would say that, there has been not even 1 or 2% upward surprise to earnings. Now, there have been sectors which have done well. But again, doing well, not with respect to the expectation, but with respect to the overall performance, which was again expected. For example, metals have done extremely well, but that was a known thing. Now, there have been some surprises in autos, but then there were a couple of negative surprises. Banks have in general surprised positively. The one sector which has surprised negatively on a uniform basis against expectations has been construction and capital goods, where both sales and margins have been disappointing. This is because of execution slippages, but this is the second consecutive quarter, and we have seen some of the stocks in the sector, the way they have reacted post results.
Just on that basis then, Prabhat, and stripped of any global developments for our market, would you be surprised if you saw us break the upper end of our range? I mean, would you be surprised if you saw the Nifty trading at above 5,500?
Difficult to say, frankly, Mithali, but the markets are being driven by global, very macro tailwinds at this point in time, not to do with earnings. So there is nothing out of ordinary in earnings. In fact, if anything, if you look at over the last 6 months, there has been some downgrade to earnings as far as consensus is concerned. So it's not an earnings tailwind; it is a macro tailwind which sort of has been imparted. I think that it's about 6-7%. I probably will be a bit surprised if it was to happen in the short term, but there is always a chance, because you have essentially as I said, you have taken the risk off the table. So there could be an up move, but not because of earnings. It will be primarily a tailwind because of macro liquidity that flows into the markets.
Just coming back to that point you made, Prabhat, about the liquidity situation, how are you assessing flows at this point in time? And are you expecting any kind of shift in asset allocation to emerging markets?
Well, so we have, in fact, in our global portfolios, we are underweight on emerging markets, primarily because of the fact that we judge the valuations. The performance last year was fantastic compared to the developed markets, and in fact, we were positive on US, negative on emerging markets, and negative on European. What we have done essentially is kept that underweight position globally in a portfolio that is Ian Scott, our global strategy, has kept his underweight on emerging markets still. He has brought down the U.S. Positive stance and put that money to work in Europe. So frankly, at this point in time, we essentially still remain overall underweight on emerging equities. Having said that, I think there will be some positive flows because of the fact that you have growth, you have decent requirement of capital, and your economic fundamentals in terms of GDP growth are still okay. So there will be positive flows. At what pace? It still remains to be seen.
Just need to get your thoughts on the entire high beta space and how you would really deal with the kind of volatility in spaces like real estate. Anything that you would back there?
So we have been positive on real estate, but in the short term, when we started this year, from strategy perspective, we had a underweight position. We are reviewing that primarily because I would say that part of the fact that we were negative essentially because we thought that there will be tightening led by inflation, and in this kind of environment, really speaking, you probably will see policy falling a bit behind, given that central banks will be even more cautious to raise rates given the global uncertainty. So it's quite likely that this space performs in an environment such as this. And high beta, which sort of has been a big underperformer through the year, at least YTD, could actually get a leg up.
How do you think this China situation will play out, Prabhat? There's been quite a bit of pressure on metal prices because of it, and indeed on natural resource stocks. Are we primed for a bit of a rebound, or you'd be cautious on it?
So again, I would qualify this. First of all, our view on China growth still remains pretty strong, our house view. Now, so far as metals are concerned, now you need to distinguish between the traded metals and the metals like steel, which don't trade, where there has been no correction. So actually, financial assets had actually more of a correction than the real sort of things like steel and coal did actually pretty well, and they're still doing well compared to zinc, aluminum, copper, which are heavily traded and have huge financial interest. So they tend to be more volatile. We have sort of kept our stance through the year that we are more positive on things like ferrous. We are more positive on ferrous than non-ferrous, and I think that stance continues.
Always good speaking with you, Prabhat. Appreciate you joining in this morning. That's the view from Nomura. Quite a bit done by way of price damage. They reckon things should be looking up from here, and especially in Europe, there may be a resolution that has finally come to shape and form. The market